Very smart. And I actually, there's something I want to add on to here too. I think I said I'd take any questions too on the classical sampling. So I think I might leave that to the end of class because some people have already turned in the classical sampling. And so I don't want to take class time for people who've already turned it in. So at the end of class, and let me get that on here. So end of class, I'll take questions on classical sampling one that is due, I think it's due Friday, isn't it? Yeah, it's due Friday. Okay. So tonight we're going to finish chapters 1 and 2 of Handout. I think there's only a couple pages left to do on that one. And then we're going to start on chapters 10 and 11. And we will hopefully start statistics, the monetary unit sampling, which is kind of it's a type of sampling only used by auditors. It's a purpose-built sampling method just for us. No one else can use it. All right. Save that. And let me pull up. So chapters 1 and 2 handout. Okay. So corporations. Okay, so do corporations, do they have to follow, if you're a non-issuer, do you have to follow state laws? If you're privately held?
Nope.
Nope. Yes, you do. If you're privately held, you have to follow state laws. If you're publicly held, you have to follow state laws. Every corporation has to follow their state's laws. Publicly traded companies also have to follow federal laws. So, if you're publicly traded, you have to follow state and federal laws. If there's a conflict, the federal laws always win, but that usually isn't a problem. By the way, does anyone know what states have the toughest rules on corporations? But what state do you think probably has the toughest rules on corporations?
Chicago.
No. Yeah, California is probably the state that's going to have the toughest rules on them. And here's the really hard one. Does anyone know what states have the most lenient rules? Almost every bank is incorporated in the state.
Delaware.
Yep. Delaware Corporation. They have the loosest rules, especially for financial institutions. So they are the ones that you see a lot of especially financial institutions are Delaware Corporation. In fact, they're actually termed Delaware Corporation. That's a Delaware Corporation. It's like they have very loose rules though. Okay. So we're going to go over some of the CPA firm types, and then we're going to. Oh. Okay. Let's just get on with it. Okay, number 7. I'm not sure. This might be on your page 8, maybe. I cannot share my spacing. Okay, CPA firm types. And they generally break them up into 4 different types of firms. And that is a local firm, which might operate in one city or one area of a state. So it might be out Naperville or Naperville area that they are generally working. And Local firms probably do few, if any, audits. They do a lot of taxes. Both individual and they'll do bookkeeping a lot of times. Advising. So this is kind of way, and by the way, the size of the firm, these are usually the smaller firms. The size of the audit firm usually reflects the size of their clients. So you usually don't have a small local firm that audits a large company. They simply can't do it. They don't have enough people, and they don't have enough places around the world. If you want to audit Ford Motor Company, well, Ford has manufacturing plants all over the world. So it's really hard for a small place to audit something like that. So anyway, they do a few audits, if any. There's many local CPA firms that don't do any audits. It's not required for many of their clients. But you know, they'll do tax, they'll do bookkeeping, they'll do advising, they'll do those sorts of things. And you know, and nothing wrong with it. It's just that they have a different kind of business than most of the other ones. Regional firms are firms that are big in a certain area. They're a little bit larger. These are kind of like, as a I would say, medium firms. And a lot of times they may be involved in, you know, 1 or 2 states or 3 states even. A regional firm would be someone in the area that does auditing and has clients in, say, Illinois, Wisconsin, and Indiana. You know, that would be kind of a corridor or whatever that they would be. So these are usually in maybe a few states. It could also be in, you know, in just one state if they had a larger area, and they usually have several, and they will do audits, because a lot of times they'll have clients that are medium size, and they get to a certain size, and the banks will say, "Look, we got to have audited financial statements." Even if you're not publicly traded, they'll say, "We want audited financial statements because we have this loan agreement. We want to know that you're living up to this loan agreement." So they will do audits. They will also do these other things here. But for the most part, they will definitely do audits. National firms will have offices in almost every state, or at least every region. And they will do audits for both non-issuers and issuers. You know, that's not actually true. They'll actually do some of the bigger ones too. There are some national firms that actually do some of the larger ones. Grant Thornton is one that comes to mind. But anyway, auditor of non-issuers and issuers. So they'll actually be doing publicly traded companies also. Most of these, the audits here, are usually non-issuers. I left the letter out here. Privately held, usually larger, medium-sized businesses are privately held that need they're big enough that they need, you know, they may be, when I say small, I mean they may need millions of dollars in financing and all that kind of stuff, but they are not publicly traded usually, and that they're doing audits basically for banking and that sort of thing, banking partners, investors, that sort of thing. Okay, and they will do consulting. Is usually a very big part of it. And the big firms I probably don't need to put on here. The biggest companies will all use the biggest firms. These are international firms. They will have offices all over the world. They'll have offices in India, Russia, all these, any country you can think of. Singapore, China, France, Germany, blah, blah, blah. They'll have offices all over the world, and they need those because their clients will have operations or offices all over the world. And, so that's why these bigger firms are usually pretty much the only pick that you can do for some of these very large corporations that are, international. So generally the size of the company kind of matches up with the size of the firm. And just so you know, the big four firms, they've kind of condensed down. When I was going through, there was a big 8. Arthur Anderson got booted out, and then it was condensed down, and so now we're down to 4. But basically, a lot of the larger companies, this is kind of their choice of. This is what they really have the choice of having who does their audits is basically one of those 4. So, the larger the firm, the larger the clients usually. Not that they won't do smaller clients, but their bread and butter comes from the bigger ones. Okay, this is very important. I know it doesn't sound like it would be, the CPA firm organization. The AICPA assumes these titles for different levels in the organization. So much so that they say, look, if you don't have these titles, for every person that you have working there, you have to fit them into one of these. So you may call them something else. Maybe you don't call them staff assistants. Maybe you call them, junior auditors or something. You have to fit them into these 4 different categories. So this is the AICPA, their kind of rules as it comes to these different levels in the organization. Okay, staff assistants, 0 to 2 years experience. Oh, that's not a 0. So when you first get a job as an auditor in a CPA firm, this is where you start. And basically, do what the senior auditor says. That's your job. That's your job description. Whatever the senior auditor says, you do. Now, basically, when they have these people start out in these in this position, they want you to learn as much as you can, and they'll actually do kind of a rotation. If they don't do a rotation, they're probably gonna let you go. But they'll try to do a rotation that you can do different parts of the audits. They might put you on cash. They might put you on inventory on a different audit. They might put you on the revenue cycle in another audit. They might put you on fixed assets, property, plant, and equipment on another audit. They'll move you around because at the end of 2 years, hopefully, you'll become one of these. And by the way, these years are kind of rough estimates. These are, especially going up here, sometimes people are seniors for 6 years, maybe 7 years. But. Okay, now this is where you start getting responsibility. You must be a CPA. So if you are in a staff, if you are a staff assistant, while you're being a staff assistant, it's kind of expected of you that you will sit and pass the CPA exam if you haven't already. if you don't pass the CPA exam, they can't move you to this spot. Every senior auditor must be a CPA. All right. And they will usually run an audit. So they'll oversee the audit. Not that they won't talk with the managers and partners, they absolutely will. But the daily running of the audit is going to be done by the senior. The senior is going to be there all the time. The senior is going to be the one that hands you what you need to do. They're going to check on your work. They're going to run the audit. And then notice that this is if you think about it, this is a pretty quick learning curve here, right? I mean, 2 years out, hey, you're running the audit for IBM or Ford or whatever. So, seniors, you really get moved up quickly. And I'll talk about how this all plays out in a second. Managers. Say 5. I've had 12 years, and they will run several audits at once. I should say oversee. So they might be watching the IBM audit. They might also have an audit of some other company, Abbott Labs or whatever it is. They could oversee several. They have several seniors working underneath them, and they will keep track and dibs on all those. And whatever problems come up, they will deal with those problems. And but they will run several audits at a time. And the highest one you can get is a partner. And a partner, someone made it in 10 years. The partner's job is to obtain clients. And by the way, that's every partner's firm. Everyone who's a partner in any firm. That's how they get to become partners, is they obtain clients. That is their job. They could be horrible auditors, but if they can bring clients in, they're great partners. So to make partner, you're there to bring in business. And really being a partner is kind of like a really high-end sales job almost. It's a lot of time entertaining clients, a lot of time going to golf courses, a lot of time, all this kind of stuff to bring in clients. So partners are there to bring in business. Now, there is something a little bit sinister about this, about a partnership here, and the entire organization. They have to have partners, or else the CPA firm dies. So they have to have partners. And here, let me switch. Didn't mean to do that. Let me. You need to ramp kind of what that happens. Okay, so okay, so you have a partner, and here you have managers. Okay, and here you have seniors. And down here you have associates, and they usually don't call them auditors because they're not, they usually don't have the CPA license, but they're referred to as associates, that they are directed by the senior. Okay, here's what happens though. I don't know if I talked about this before or not. You have to have partners to survive. Now, these associates, you know, it's a rough road, like 1 in 100 will become partners, but you have to have a partner to survive. You cannot have an associate plug up that spot. You know, if you get to 2 years and they can't be promoted to senior, you can't just let them sit there and work for 15 years plugging up that spot, because that spot might be taken by someone who could be a partner. So in a CPA firm, it's either up or out. That you either get promoted or you get moved out. So if you have a senior that they can't make into a manager, they don't think that you can become a manager, the senior's got to go. Someone else is going to come up and take their spot, because that person that coming up to take their spot might be able to make manager and then might be able to make partner. So for the partnership to survive, you cannot have all these, you know, eventually, if you let anyone just sit down here, you could have this whole thing filled up with people that can't get clients, and that would be the end of the partnership. So as ugly as it sounds, it's up or out in partnerships. Now, you might say, well, that's horrible. What a horrible thing to do, you know? And most people, like I say, 1 in 100 make partner. So the other 99, you can guess, at some point, you know, it might not be for 15 years, but at some point, you know, they get moved out. And again, that's not just for CPA firms, that's every, you know, every partnership, law firm. You may have somebody in a law firm that can't be moved up. If they can't be moved up to partner to where they're actually obtaining clients, you got to get them out of there, because you get someone else might come in there who can get clients. So it's up or out in that. Now you might think, oh, that's horrible. What a horrible thing to do. It's actually not, because what they try to do is they try to get their, you know, people that work with them, they try to get them jobs with the clients. So if they're auditing IBM, they'll say, look, IBM, we got this associate. We don't have a spot, you know, a spot for, you know, him or her, and you know, you. And oftentimes these clients will say yes. Why? Because they know that these, you know, usually the higher, you know, they have the prestige of the CPA firm. And some companies will even say must have 2 or 3 years of experience in the CPA firm. And they do that because, you know, they want that, you know, they have that prestige of being in a CPA firm. The nice thing about that is, and especially if you get up to the senior level or around there, is that, you know, you're in charge of a huge audit or two when you're basically, you know, right out of school, you know, 2 years out, you might be running an audit of a very large firm, a very large company. So that kind of experience really leapfrogs you, you know. So, you know, I tell people, you know, 2 or 3 years in a CPA firm is like 10 years going up the regular way in accounting. You know, a lot of times they'll slip you right in as a senior, you know, senior analyst or something, or, you know, senior accountant. You know, when you've been in the, you know, you have 2 or 3 years of audit experience. So, you know, being moved out is not usually as bad as it sounds. They can get you a job with their client, they'll do it. One of the clients. So if it were auditing IBM, you might say IBM, yeah, you know, Sarah, but, you know, do you guys have a spot for? Oh yeah. So that's the kind of how they operate. And usually going to the other jobs is, you know, the pay is better, they treat you better. Working in a CPA firm is huge hours. You know, 9 to 9 is not unusual during the week. I had a student who came back and told me one time, just as a senior told him, on Sunday, just you can come in at 9 on Sunday, 9 to 5 on Sunday when they're in the busy season. That's just the way it is. So anyway, they generally treat you better, and you've already jumped up. Now it's hard to get into these firms. It's hard to stay in these firms, but that's kind of the draw of it. And the more you stay in, usually the higher the position coming out. But so that's what it's like to be in a CPA firm. It's kind of the gist of it. Any questions on that? Now you might wonder, well, why does the CPA firm, why do they try to get them in with their clients? We're doing the IBM audit, and why would they try to get me a job at IBM if they're going to let me go? It's not because they're nice, because they're not. They're pure business. But why would they do that? Why would the auditors of IBM try to get, when they're releasing somebody, when they're letting them go, laying them off, why would they try to get them a job with that client or even a different client that they have? Why would they do it? Why do they care? Why don't they just say, pack up your desk and leave? Anyone?
Because it makes their job easy. You go there and you help with internal audits, and so when it comes to them auditing you, it becomes less difficult. You didn't have to deal with a lot of issues because you have that experience of making sure.
That's exactly it. And whenever it comes up, who should be the auditors? Well, you're going to have 10 people there that says, "Well, I worked for Deloitte too," or whoever it was. It's their foot in the door, and two, a lot of times those people that go into those places, they end up in different parts of they don't just, a lot of times they don't just always stick in accounting. They go to other parts, and they get more business that way from consulting and all that kind of thing. So it does them good to have those good relationships with not only their clients, but with also the personnel in that firm. So and why you might say that's a little bit underhanded or whatever, it's just kind of the way it is, and one thing you got to remember too is that, and this is about all businesses are social. People try to make them into a science, but they're not. They're social. And you can't tell you how many times people say, "Oh, why are you with that company?" Well, there's Sarah there is great. She takes care of everything. She does. It's social. It's not a science. Okay. Did I already talk about the Foreign Corrupt Practices Act? I thought I did. No, I didn't. Okay. All right. Foreign Corrupt Practices Act. This is the first act you should say first law This is the first law that mandated publicly traded companies, mandated publicly traded companies to have, I don't know, I wrote that. My wife's English, well, was an English professor, now she's a therapist, but she cringes when I talk her right. That mandated publicly traded companies have a system of internal, can we say they have internal controls, basically, the Foreign Corrupt Practices Act. And the way it came about was, it kind of came, and this is back in the 70s, that many US companies were actually doing business with other governments by bribing officials. So they'd go into some small country and, trying to sell whatever, trying to sell them tractors. And normally, why do you sell tractors? You get the best quality and you know, give them the best price. No. It's easier just to go in with a few $1 million, pay off a few officials, have them, the government buy the tractors from you at some inflated price, and that's just how they did business. And you know, the country itself was being impoverished by these deals, and it was obviously that this was not, you know, on the up and up, and not the way we usually do business, at least in the United States. So Congress got a hold of this and said, okay, you know, let's bring all these presidents in. And they brought all these presidents in, and they showed them, you know, look at your company paid, you know, $800,000 to, you know, this person, and to this person, and then you got this contract, and it was about, and every one of them said, you know, I didn't know that was happening. If I knew that was happening, I'd have put a stop to it, but I didn't know it was happening. I don't know what goes on over there. So Congress didn't think that was funny, so they said, okay, and basically the rules for the Foreign Corrupt Practices Act are that every transaction is done with management's knowledge by law. What that did is that took away the argument that I didn't know that was going on. By law, you did. You can't use that. By law, you knew every transaction that went on. So this was a, you know, really put management on the spot. There's a few other things in there too about securing assets and record keeping and all that kind of stuff. And this is every kind of, so this required they have internal control. Now, this is only for bribing foreign officials. So it's kind of limited. It's only for bribing the, spell that, governmental officials. You know, and again, it's governmental officials. This is not, you know, if you want to go over and there's someone running their own business over there and you bribe them, that's not covered by this law. It might be covered with something else, but it's not covered by this law. So it's only for bribing government officials. And it's not for things like coercion or kidnappings and things like that. It's only for bribing of government officials, basically for contracts. So it's actually fairly narrow, but it told companies, look, you have to have a system of internal control because every transaction is complete with your knowledge. So you have to have internal controls that every transaction is known by management. So it's kind of a unique act in that way. It was the first one, you know, and now it seems like it should be obvious. Before the Foreign Corrupt Practices Act, if a company wanted to have bad internal controls, it was up to them. You know, if you don't want to have any internal control, that's fine. You don't have to. You know, whatever you want to do, it's fine. When this act came out, though, then it was like, okay, we at least have to have internal controls in place to look at this stuff. Question on that? Did we talk about the Sarbanes actually act? And I know I keep asking these stupid things, but no, I'll go over it. I thought we did. Didn't I skip over this?
Yeah, I think you did. You did.
Yeah, Sarbanes actually acted. I think I did it up here somewhere. I'll quickly go through it. It's just a Sarbanes actually acted. It just is an act that it was to calm the markets, basically. It was an act that was around for many years that no one wanted. The companies all killed it in Congress. And after WorldCom and Enron, they said, please pass that act because no one believes us anymore. They don't think our financial statements are garbage. So Sarbanes-Oxley Act, and what it does is it manages controls over accounting and auditing for publicly traded companies. So it's only for publicly traded companies. If you're Joe's Hot Dog stand, this does not apply to you. It's for both the corporations and for the auditors. And it's there to hopefully avoid some of the problems you have with the financial statements, and especially the really large fraud cases. You're always going to have fraud. People say, well, how do you prevent this from ever happening again? And I would say, well, if we're going to prevent a crime, let's start with murder and then go to rape and all the terrible ones. I mean, you can't prevent crime, you can't prevent fraud, but you try to make it as difficult as possible for someone to do this. So anyway, it's there to help avoid some of the problems that happened in the past. So, well, we will not stop fraud; it never will, because humans are involved, and we're not perfect. It will hopefully avoid some of it. Okay. Yeah, listen. Corporate government, board of directors. And this is for issuers. So board of directors, they oversee and by the way, the term that you'll see in the AICPA all the time is governance. When they say governance, they're talking about the board of directors and or the audit committee. So issuers and non-issuers will have board of directors. Directors can be inside or outside directors. Oops. Lazy here. So inside directors are people who work inside the company. Outside directors are they're directors, they're overseeing the company, but they do not actually work for a company. So they might be on the board of directors of IBM, but they don't actually work inside IBM. So inside directors are people who work inside the company, and these are, you'll see on the board of directors, you'll see that the CEO will work in the corporation, will also be in the board of directors. It's not going to have the president, chief financial officer; those people will all be on the board of directors. Not necessarily a bad thing, because you want to have people who have real knowledge of how the thing works, how the company works. But you can have problems too with that, because inside directors, they're kind of, if you think about it, they're kind of overseeing themselves, right? If I'm the chief financial officer on the board of directors, okay, I'm having oversight of the company with the other directors too, but there is a little bit of, I'm overseeing myself. So inside directors are generally not as clean as the other ones, as the outside directors. Okay, audit committee. Issuers must have an audit committee. Non-issuers may have an audit committee. Issuers must have an audit committee. This is a separate committee, a subcommittee of the there's a subcommittee of the board of directors. So, yeah, 20 people on the board of directors, maybe there's 5 people in this audit committee. If there are issues, they must have an audit committee. Consisting of all, should say, only is a better way to put it. I'll put this down just for aesthetics. Okay, so they must have an audit committee. That's not, should be and, should be and. Consisting only of outside directors. So they can only have outside directors. You cannot have, say, the chief financial officer on this audit committee. Only outside directors. Why? Because the audits are for people outside the company. So an audit committee for issuers, this publicly traded companies, they must have an audit committee and it must be made up of outside directors. They also have to have an accounting expert. When this first came out, that people assume that means they had to have a CPA on it. They don't have. You don't have to be a CPA, but it had to be somebody who's familiar with making financial statements, creation of financial statements. I know this sounds strange, but a lot of times on these board of directors, you get people in there for all different kinds of reasons, and many of them have never done anything in auditing or even financial. They're there for other reasons. Not that there's anything wrong with that, but long story short, if you want to have somebody to oversee the audit, they should probably have at least have somebody on board who's familiar with that function, making financial statements. So must be outside directors, and they must have at least one accounting expert on the board, and that's for issuers. Non-issuers, they can have an audit committee. They don't have to, and it can consist of anyone they want. But an audit committee for the is required for issuers of financial statements, and it's part of the board of directors. So. So we have our board of directors. I know this is going to look childish, but so here's all the people on the board of directors, and I realize how stupid this is. Okay, so here's the board of directors, and the audit committee will consist of some people on the board of directors, and these must be outside directors if it's a publicly traded company. If it's not publicly traded, they can be insiders, but they must be outsiders if they are publicly traded. Any question on that? Okay. These are the 5 business processes that are 5 components that the AICPA, this is from the AICPA, five business processes. The new thing is that we audit the processes and not necessarily the individual accounts. And this is kind of a big change. That I'm still kind of wondering how this is going to work out and if it's going to change anything in auditing. And the reason I say that is, first of all, there's nothing wrong with it. And we've always looked at processes. We always looked at the processes of, looking at the entire, at the big picture process of whatever's going on. Here's the problem that arises from this, is this is not usually the way auditing is done. In that, for instance, the financing process, as you can imagine, that probably has to deal with cash. The purchasing process, as you imagine, that probably has to do with cash also. Revenue process, you guessed it. Usually you do cash all at once. Why? You get all the documents. Most of auditing is document driven. You go get the documents and then you make sense out of those documents for the individual accounts. Now, again, nothing wrong with breaking it up and putting it in different processes. And I imagine that's what they probably do. They probably still do the cash, say, all at once and then split it up. Inventory. Well, purchases and inventory go together. And of course, the inventory process will have inventory. So my guess is they're probably doing inventory all at once and then splitting it up into the processes. That would be my guess on it, just because audits are generally document driven, and that you actually look for the documents that are evidence. So now, having said that, when it comes to CPA exam, this is what you say. It doesn't matter what I think. It doesn't matter what anyone else thinks. You answer them. You answer these questions and so forth the way the AICPA tells you to. So, this is, like I say, it's kind of a new thing. But anyway, when I'm going to go over this stuff, I'm going to go over them as individual accounts, just because that's the way you're going to see it mostly. I can't imagine that you'd have 3 different groups all going through cash separately. 3 different sets of auditors going through cash separately. I wouldn't believe, talk about irritating a client. You want, it's a pain in the butt to have one set of auditors come through and look at the cash rather than having 3 different groups that will come through looking at the cash. So, but anyway, long story short, now the actual testing for these has not changed. None of the stuff has changed the testing. The testing of accounts and the tests we do in auditing, despite all these changes in wording and all that kind of stuff, the actual audit procedures haven't changed. Quite honestly, they haven't changed for years for the most part. I mean, a little bit, but because of computers and that, but not much. So anyway, all right. So that winds this up. So this is anyway. Here's why I'm telling you this. I've made the decision that I'm going to show you guys how to do the actual audit steps for cash, inventory, accounts receivable, that sort of thing. Simply because it's probably the way you're going to see it. And also on the CPA exam, a lot of times those stuff fire questions at you. How do you know this? How do you know that the accounts receivable are being posted correctly? How do you know someone's not taking the cash and running away? So all those types of things will be, those actual audit steps will be tested in the CPA exam, and that's what I'm going to show you. So I'm going to do these. I'm going to do the actual testing stuff, and then I think we're going to get back into the more theoretical stuff of which evidence is better and which is required, which isn't required, and all that kind of stuff. Question on that? Okay, I'm going to make another thing here. I think what I'm going to do is, I think I'm going to start the monetary unit sampling. So I think we'll wait on this one until next week. We'll wait on chapter 10 and 11. Okay, so this one we'll do next week. So today we just finished the chapter 1 and 2 handout. I'll put a drop for that in the, all right, I think I put it in. And so I think we'll start on this one, monetary unit sampling. This one we're going to spend a little bit more time on. It's a little bit more quirky than the classical sampling one, but in a lot of ways it's better. And then I'll leave time to question if anyone has any questions on the classical sampling handout. We go over it. Okay, so I'll tell you what. Let's take a break. What time is it? All right. Let's come back at what, 7:05? Is that okay? Okay.
Yeah.
Thank you. So I'll be back at 7. And we'll start the monetary unit sampling.
Okay.
So this is what we'll start next, and that's yeah. And again, we'll do this next week. We'll start on chapter 10, 11 is cash. It's in a couple other chapters too, but the main 2 chapters are 10 and 11. Okay, go ahead and take a break. You know, let me go ahead and pull up the monetary unit sampling. In monetary unit sampling, it kind of came about because doing auditing, and this has happened almost every time I did auditing and I did a sample, it either fell into one or two categories. So let's say I'm supposed to get a sample of 80 items or 100 items. Well, let's say 100 items. By the time I got to the 40th item, I kind of knew where it was going, good or bad. You know, if you get to 40 items and there's not a hair out of place, you know, you can kind of tell that, okay, this is, you know, everything's going to be up and up on this. There's no problems here. Same time, you take 40 items. When things are bad, they're usually really bad. It's not usually one account or one thing, you know. So you get a thing of 20 of them, or 40 of them, and 20 are bad. That way you go, okay, I think I know what's going on here. The point being is the classical sampling, a lot of times, just intuitively, it seemed like the sample sizes were too big. That you actually knew what was happening, especially if you're dealing with accounts that are usually don't have problems. You know, if you're dealing with a company or accounts that usually don't have problems, the sample size is just way too big. That by the time you got halfway through it, you knew exactly where it was going. And by the time you finished it, again, you knew it. So, and just so you know, the testing is the most expensive part of an audit. Testing, going and pulling invoices, matching up the invoices, all that kind of stuff. We go through the steps. There might be 10 steps on you're testing something. That's expensive. That's what takes hours to do. So if you can somehow reduce that, and you know you're always trying to be more efficient. You know, you're already working whatever 80 hours a week, or you know, so. This method, in some circumstances, the monetary unit sampling is a good one to use. So having said that, let me kind of go back to monetary unit sampling. This is sometimes called dollar unit sampling. It's commonly called probability proportional size. So these are all the same thing. So monetary unit sampling, and you'll see these on CPA questions. They mix them up. You'll sometimes see this called let's go PP. Oops. I've already seen that one abbreviated, but maybe I'm sure it could be. Okay, so anyway, these are all the same thing. So these are all the same thing. So let's take a look at this. This is the information we have. So here we have the book value of each item. Should have done this differently. But here's the book value of each item that we have. And then over here's the audit value of those items. And here we have a cumulative book value. So this is adding up. Well, so start out with 500. Yeah, cumulative, maybe we take the 500 and we add 200 to it. You know, so it just keeps adding up. 700 plus 600 is 1,300, and so on and so on. So it all adds up to $5,000. So this whole accounts receivable is valued at $5,000. Okay, so this is just adding it up. This is just a cumulative total. And I'll show you the kind of the idea behind it. So here's what we're going to kind of do. We're going to break this accounts receivable up into chunks. Oh, I didn't do that very well. So we have this accounts receivable, and I'm going to okay, so it's worth $5,000. So this is $5,000. And we're going to take a sample of 5 items, but before we do that, I want to kind of go over what we're actually going to do with it. So we're going to take a sample of 5 items. So here's what we do with this. You say, okay, there's 5,000. We're going to take this into 5 different items. So we're going to take that 5,000, divide it by 5, and it'll come out to be 1,000. So here's what we're going to do. We're going to break this up into chunks of $1,000. And these are called intervals. So we're going to take this whole $5,000 account, break it up into $1,000 chunks. And what we're going to do is pick one item from each of these intervals to represent the entire interval. So we're going to take one item out of here and say, okay, what does that one do compared to the entire one item? So we're going to break this up into 5 different okay, so sampling interval will be $5,000 divided by 5 items equals 1,000. Okay, so what we're going to do is say, okay, so every interval is worth is $1,000. So what we're going to do is go down the list here. And we're going over this cumulative book value thing. And let me get rid of all this stuff. And we're looking for the items that cross the interval. So which items are going to cross, which one crosses the first 1,000 interval? So we want the item that crosses the first 1,000 intervals. So that first one is going to be item number 3. Now it crossed that $1,000 interval, went from 700 over to this. Okay, so now we're going to look for the one that crosses the $2,000 interval. So going to the same column here, the cumulative book value, which one crosses the $2,000 interval?
6.
6, yep. So number 6. So that's going to be our second one. So which one are you? Let me see. Yes. So far we got, oops, 3, 6, 7, oops.
9.
Yep. And lastly, 10.
10.
So this is, wait, let me see here. So this is that. Okay, so these are the items that we're going to pick. And we're going to let those one items represent the entire interval. Okay, so coming down here, I should try to get these more on one page here. I don't know. Okay, so let's take the first one, item number 3. We're going to say audit over book. So the audit amount was, wait, I'm going to change this color. I'll change this to something's wrong here, right? I don't have enough. I didn't highlight number 7. Oopsie daisy. Okay, so we have audit over books, so we're going to take 600. Move this up. Yeah, wrong. Who made this stupid handout? All right. So the audit amount was 600 divided by 600. Okay, and true, notice that equals 1. And we're going to times it by the interval. I got to do this differently. I could already do this handout. I can tell right now. So the interval was $1,000. So the projected value is $1,000. Projected misstatement is 0. And let me get rid of all this crazy stuff I have here. Okay, we'll go to item number 6. Okay, so this is the book value. Audit value. Okay, so item number 6. Okay, the audit value is 560. The book value is 800. Times 1,000. Okay. Times with your calculator. So 560 divided by 800.
700? Is that right?
I don't know. You're faster than I am. Yes, you are right. It's 700. So this would be 700. So we're projecting onto this financial statement, this that interval, that 700 of it will be the value. So how much is it misstated by? That interval.
300? I don't know.
How much?
300.
300?
Yeah, yep, 300. So this is misstated by $300. Okay, so we want to number.
So for this one, do you say it's understated or overstated?
For this one, we're going to say that it's overstated.
This what?
It's overstated.
Okay.
And I'll tell you why when we get kind of near the end of it. I'll show you a little bit reason why this one. This is actually only good for overstatements. This method.
Oh.
I'll show you why in a minute here. Am I at number 7? Okay, so this is 450.
Over 450?
Yep. So this one is okay, right?
Mhm.
This would be so there's no misstatement on that. These are
400.
okay. Let's see. Number 9, we had 300. The audit value for that item.
750. So it's so that will be times
What is it?
400.
How much is it?
400?
400. So this would be $400, and the mistake would be
6.
Yep. Is 900. So this one's okay. 900. Okay, so this would be our projected. So projected misstatement, we'd add all these up. You can look at the projected value. Most of the time you just use a projected misstatement. So go over here. I'm doing this. I can't see my screen. It's just camera in my way. Okay, so let's turn off all this stuff. I gotta redo this one so we have better working space on it. All right, so this would be our projected misstatement. And that's kind of weird looking. Okay, so projected misstatement would be adding up these 900, yep. So our projected misstatement would be $900. And this is an overstatement. Now, here's the thing that's quirky about this method. There's some really good things about it, but there's also one thing that's quirky. If there's an understatement, if we understated an item, like the book value is understated, is it more likely or less likely to be picked? You know, so, you know, if this, instead of being 600, if this was $50, would this one have gotten picked? No. This method is only good for overstatements. Oops. That's probably the biggest drawback to this method. It's only used for overstatements. But it works very well for overstatements, is why we like it. But it's only used for overstatements. Notice, you know, if they put item number 2 in as 0, you know, there'd be no chance that one would be picked. Right? I mean, you know, it's not going to put you over the threshold. So this method is only good for overstatements. But now it's very good at overstatements. And you know, the reason why it's so good at overstatements is, oops, here's why it's good at overstatements. Whatever the interval is, I can't read it on the camera. Whatever the interval is, you know, for instance, in this case, 1,000. If a company's trying to cheat, right, and overstate their books, the more they cheat, the more likely that item is going to get picked, right? So the more likely it's going to get picked you know, so instead of $500, they put on at $800. Now it's much more likely to be picked because it's much more likely to put them over that interval. And if they cheat enough, you know, if they cheat over $1,000, guess what? It's 100% guaranteed that item will be picked. So the more, you know, they cheat, say if they do it on one account, you know, it's 100% sure it's going to get caught. But even if they do it on a number of accounts, it's say, okay, we're going to bump up all the accounts by 10% or whatever. Those accounts are more likely to be picked also. So it's excellent at finding overstatements, because the more they overstate, the more likely the problems are going to get picked, the more likely you're going to catch it. So it's only good for overstatements, but it's really good at overstatements. And it's really good at overstatements just because of the way it works. And it does two things that are somewhat subtle when you kind of look at it, and that is it actually picks your sample. You know, you're not going to a random number table and trying to find randomly what numbers there. It's specifically picking those things that cross the line, you know, across the intervals. So that's one of the beauties of this method, is that the more they overstate, the more likely it's going to be picked. So, question on that?
Yeah, I have a question. So as an auditor, before you start doing your audit, you don't know whether the books have been overstated or understated. So you come in blind. So then which, like you come in blind, so how will you know whether to use the user monetary or this as statistical? Because if it's understated and you use this one, the monetary, you end up wasting your like sort of wasting your time.
Exactly.
Because-
Yeah, and they'll usually only use it on accounts that they feel would be more likely to be overstated. So if there's a company that's trying to make their, income numbers like that, they'll look at their sales. It's more likely if they're trying to boost their net income. One way to do it is by boosting their sales, maybe putting fictitious sales on the books, that sort of thing. So you're looking at those things that are likely to be overstated. What are things like to be overstated for a company? If they're trying to make themselves look good, revenues, assets, those sorts of things are going to be, inventory, those things are going to be the ones that they'll be likely overstated. When is this not good to use? Liabilities. Very rarely do companies want to overstate their liabilities. Right? Now, if you're unsure, you walk in, and it is possible that companies don't want to have higher income, they might have lower income. Why would a company want to have a lower income?
To avoid paying a lot of taxes.
Yeah, exactly. While income is great to show to people, it's really bad when it comes to paying taxes. You don't want to show a lot of income, you show a little bit of income. So if you're unsure, okay, we're auditing this company, maybe we've never audited them before, we don't know what their philosophy is or anything like that, you're going to want to use classical sampling. If you're not sure whether they're overstated or understated, or what the pressure is to overstate or understate, you would use the classical sampling. The classical sampling can be used in virtually any situation, overstatement, understatement, whatever. This method is only used for overstatements, and only when you feel that that there's such a significant pressure that that's going to be the danger, that they're going to overstate something. And one of the things too, especially when you talk about things like revenue or assets or things like that, if you're an auditor, you usually are going to get sued if you don't catch them overstating, say, revenues or assets. If they're understating them, people usually don't get mad. If there's 110 million worth of inventory rather than 100, people generally don't get mad at you for that. I mean, they can, but usually you get sued when you say that there's 100 of inventory and there's really only 85 of inventory. That's when the lawsuits start flying. So, you're going to use it only on those situations where you believe that the greatest danger is going to be that they're overstating it, or maybe that's the pressure on them to overstate it to meet market, the market expectations, or maybe they have certain things that they meet for, say, a bank loan. They have to have certain profitability or something for a bank loan or something like that. There could be pressure to make it look like, they have more, say, inventory than they really have. So yeah, it's not for every situation at all. Liabilities. You do not want to use this for liabilities generally. Very rarely do people overstate their liabilities. But they understate it, is what they're more likely going to do. So yeah, again, it's not for. And by the way, when I was going through, people talked about how this was the greatest method ever because it was made for accounting, and you generally had a smaller sample size, so that was all positive. That this is the way to go. It really isn't. I mean, it's very useful when it's in certain situations. It's also not very useful if there are a bunch of errors. It's usually if there are a few errors, like you don't expect it to be off by much. If there's a really wide range of errors that you're getting, this is not the method to use. And there's a reason why we get to the formula. Let's go ahead and get to the formula here. This is one of the things that we have to do is get the formula for this monetary unit sampling. The big thing is finding out how many items are in the sample. That is the biggest problem with this method. So the number of items in the sample, this determines your interval. Like we did up here. Now I just gave you this. So this was just given, 5 items. we divided the 5,000 by the 5 items and we got that. But the question is, how do you come up with those 5 items? Now, finding the sample size for classical sampling is really a pain. It's so much of a pain that I don't show it, and I don't think it's ever been fully tested on the CPA exam. I've never seen anything for a sample size. I mean, they've had general questions on it, but not how do you actually do it. Whereas this method, they actually said, what would be the sample size for this? If you know how to do it. Okay. The formula for this is at the very end. Go to the very end. We have these things, sample size and the interval. So the sample size, this is the sample size. Again, this is the very last page. I should put this up there. In fact, I'm going to copy this. I'm trying to think how to do this. They have them both on the screen. I can't think. Okay, well, I was going to copy this up here. I thought I had. Give me 1 second. I want to see if I have a different method. And I don't think I do. Yeah. Okay. Ooh, what did I do there? Okay, so what I'm going to do here is copy this one. And I should have that up here. So this is our formula. We'll do one of these and I'll call it a night. We'll save some of the flavor, some of the fun for next time. Okay, so our sample size is going to equal this, our total population, which is this. It's the population, the dollar amount. Yep. Okay, so on the top we have our total population, which is 1,600,000 times our reliability factor. Okay, new term, unfamiliar term. So our reliability factor going to come from the table. Down here, grab my table. Sorry about this, guys. I'll get this more compact form. This is what you know what this handout is made. This handout is made to do in class, and you rip off the last page, and so you have it sitting next to you. That's kind of what this is. Okay, so reliability factors. So here's our sample size. Down here, reliability factor. And it says down here, row 0 is used for the reliability factor for sample size and basic precision. Okay, so we're at 5%. And row 0. So 5% in row 0 be 3. So 5% row 0. Divided by the tolerable misstatement that was it? 25,000? Our expected misstatement is your expected misstatement. Hey, what happened?
The typo on top.
So,
I'm sorry, how did you get 3?
oh, that's from here.
Right, but how do you know it's 0? How do?
Oh, it says row 0 is used for the reliability factor for sample size
Oh, okay, gotcha.
and basic precision, which we haven't done yet.
Okay.
But sample size, we're going to use row 0. So row 0, 5%, 3. And then again, this is a quirky method. You know, well, actually getting this is it's kind of a little bit quirky, but it's actually, in reality, it's much easier than the classical thing. I know it doesn't seem that way to do this right now, but it actually is. Okay, so we need a basic precision. Okay, we come all the way back down here. I'm going to copy this, and then actually expansion factor. I'm definitely going to redo this. Okay, I'll put it down here. Now, the nice thing about expansion factors, there isn't, there's only one row. so at 5%, it's 1.6. So expansion factors are 1.6 for this one. So this will give us the number of items in our sample. So population times our reliability factor, give the table for that, row 0, divided by our tolerable misstatement. So we're saying that this account could be off by 120,000 and we'd be okay. If it's off by more than 120,000, we're not okay. Now, what do we expect it to be off by? 5,000. Notice, this gets subtracted. So if you expected this to be off by a lot, so if this is a problem account, this is a problem account. Maybe last time you're auditing is a problem account. This is a really bad way to get a sample, because notice that if this goes to 120,000, you're going to have infinity as your sample size. So at some point, if this expected amount is too high, this becomes a really bad way to do it. Okay, so there's a solve for this. Okay, so what is that? 1 million times 3 is what's that? 4,800,000. $120 minus what's 5 times 1.6? 8,000. If you have a calculator, you can probably do this much quicker than I can. So 120,000 minus 8,000 is 12.
112? I'm sorry. No.
Yeah, that's it.
Oh.
Don't be sorry, that's it. That's the correct answer.
Oh.
Okay, so our sample size will be whatever that is.
42 point something.
42.86.
One more time, hold on. 48. So yeah, okay, yeah. So 42.86.
Do we round it off? Or we just...
Yes, you do. And the actual method is that you round it off to the nearest whole number. However, if it were up to me, I would advise you to always round up, even if it came out to be 42.1. one thing about auditing is you never do anything that you would not want to admit in court. So if you go into court and you miss something and you said, well, we rounded it down, even though that is the method, you can imagine how that would play in court. So I would tell people to always just round up. It's one more item, not going to kill you, you know. So I would say always round up. But the actual method is to round off to the nearest one. So this would be
23.
Yep. So this would be our sample size.
I have a question. So in real life, right, if you get 42.86, you're saying, what do? You just leave it because you can't have a sample size of 42.86, right? It needs to be a whole number. So in real life, how?
Right. So if you're, this is going to be like how many accounts are you going to take? You know, if they have, well, they don't even tell us how many. Do here? I did something here.
Yeah.
I don't know what I did.
You deleted the expected, the
Yeah.
type expected misstatement.
Yeah, so yeah, you're going to round it up to a whole number because you're going to pick one item from each sample that will, so that it will, and assume that that one item represents the entire sample. And it actually is a ratio estimation. You'll notice that this, if you look up here, what we did up here, that's ratio estimation. It's ratio estimation on an interval. Okay. All right, so this will tell us our sample size. So 43. Okay, now we also need to find the interval. Let's put that in. How many items? 43. Sample interval. We're going to take the 1.6 million. I think I get this. I got the formula down here. And I'm definitely going to, what did I do with it? Oh, here we go, interval. This is what we did on the first one, same thing. Once we have the sample, once you have the number of items in the sample. So our interval going to equal our total book value, which is 1.6 million, divided by our sample size, which is 43. Equal, oops, equal some number.
37,209.
Yep. Yeah, so this equals 37,009.30, probably round off to the nearest cent, I guess. So this would be the interval. So the first one to come at 37,902.93.3, so 30 cents. So whatever item crossed that cumulative amount, the next one would be whatever it is. What's 37 plus 37? 74. 418, 60. Yeah, you just keep adding up. So the next interval would be that, you know, just keep adding it up until we take in the whole form, not now, 1,600,000 of the accounts receivable. So, you know, every 37,209.30 cents, you would pick another item. And that one item would represent that entire interval. And notice though, that if someone's trying to cook the books, they're trying to, inflate something. If they inflate it high enough, and if they inflate a count over $37,209.30, it's 100% sure you're going to catch it. And that's not true with classical sampling. Classical sampling, it's possible you don't catch it. But it's more likely if it's a larger amount that, depending on how you pick your sample. But this way, again, it's 100% sure if it's over $37,209.30, it's going to get picked. And so this is, let's plug this in up here. Oops. And so that, again, yeah, but absolutely right as far as caution, this is not to be used for everything. Not to be used for liabilities. They're not going to overstate their liabilities most likely. And quite honestly, even if they didn't overstate their liabilities, you probably wouldn't get sued for it. If the company, you rarely get sued if a company's doing better than they say. I mean, it's usually the other way. You say everything's okay and everything's terrible. That's when the lawsuits start to fly. But yeah. So that's how we pick it. And this formula. Now, as clumsy as this formula looks, this is actually way easier than a classical sampling formula. Classical sampling formula, you have to take a preliminary sample, find a standard deviation, and plug it into the formula. So you actually have to go get a sample to take your sample. So this method is way quicker in reality in figuring it out than the classical sampling, as far as determining a sample size. Drawback, can't be used for understatements. It's no good at it. If they put something in as 0, what are your liabilities? 0, you're never going to catch it with this one. Okay, I think I'm going to stop right here. So we'll stop here. We'll leave this for next class. And I already have the classical sampling needs to be turned in, and I'll talk about that. If anyone wants to stick around for the classical sampling, I'll take any questions you have on that. The classical sampling is going to be turned in and handout.
Friday?
Yeah. I think I'm going to hold off for now on the chapter 1 and 2 exam. I want to get the sampling stuff in first. And quite honestly, the chapter 1 and 2 exam is not going to be. I'll take a look at it.
I have a question. So with the exam, is it going to be a take-home exams?
They're all take home, and they're mostly essay. They're mostly essay. Now the sampling ones will not be. Oh, I know what I want to talk about though. Before I do anything else. Now the sampling exam, there's a large one sampling exam that's given at the end of probably like week, I think week 12, week 13, somewhere in there. If we do a one big sampling exam, because we do a little bit of sampling throughout the whole semester. So there's only going to be one of those. So and it's going to have classical sampling. It's going to have monetary unit sampling. And there's also another type of sampling that we're going to be covering later, which is it's for test of controls type of testing. But they have those 3 things on it. But that will not be until like week 12 or 13, somewhere in there. My point being is that the stuff that we're covering in this for classical sampling and for this we're covering now will not be on any test coming up for any given chapter. They're all going to be included in one sampling exam. And we'll have a practice sampling exam so that we can go through it. Make sure everybody's on board with it. But so I think next week what we'll do is we'll start in on chapter 10 and 11 handout. And I'm going to make a decision right now. I'm not going to put out a test for chapters 1 and 2. There's not that much in it. It's just all definition stuff. There's not too much thinking in it.
Okay, so just to be clear, you said all the exams is going to be take away, right? Take home exams.
All of them are gonna be taking exams. They're basically all essay exams. I mean, they're,
Okay.
and yeah. So the first one will be the chapter 10 one, which chapter 10, 11, which is the cash one. And quite honestly, that's one of the more difficult ones, but it also, it's got a lot of stuff in there. It's a good one to start with because cash covers. But yeah, so next week we'll start on chapter 10, 11. I'm not going to have a test on chapters 1 and 2. So for this week, let's make sure we get the classical sampling in as well as the chapter 1 and 2 handout. I don't think I put that in. I'll have to put that into the submittal things. Yeah, I'll get those in shortly. Any questions on it? Okay, well, if you want to stick around and do the classical sampling, I'm more than willing to do it. You do not have to stick around, and some of you have already turned in the classical sampling handout, so obviously you don't need to stick around. But if you want to stick around, and I'll go over anything you want to go over in the classical sampling. Okay. So bye if you're already done with the classical sampling, or you don't want to go over it. And if you want to stick around, of course, I will stick around and I'll answer any questions you want to do on it. Anyone?
I just have one question.
What's that?
For the homework, you said for the classical sampling, you said to do the last two, correct? But not the number 5, which is, it says which estimation method of classification sampling is better. Do we have to answer those?
Yes, you want to answer those, and let me see where mine is. Yeah, and we talked about this a little bit, I think, but the yeah, because the question is, when is it appropriate?
Right. That's the only part I'm missing.
Okay, when is it appropriate? Mean per unit. Mean per unit is good when the items are usually around the same value. So the items in your sample.
Okay.
Have a similar value, or the actual book value is not reliable. I already want to say that. My wife walks by here, she's gonna cringe. What are you doing to them? So yeah, so when the items have a similar value, it's a good one to use, or the actual book value is not reliable. If you got, if you go and look at their books and it's a mess, you can't make heads or tails out of it. Well, these other two methods use the book values. So if the book values are just wildly off, you don't want to use them. You don't want to use ratio, and you don't want to use difference, because you got one of them is just very unreliable. Half of the equation. So mean per unit is good because it only uses the audit mean is the audit average is what you use. So audit average is the only one. So we don't care what the book average is, because we're not going to use theirs for this one. Mean per unit means the average audit. So things are a similar value. So if you're running with whatever, railroad cars, I have no idea, but railroad cars, let's say railroad cars are all about the same cost, same whatever. If you're doing a sample of those, they all have about the same value, mean per unit's fine. If it's all over the place, if you have an account that's $30 and accounts that are $39,000, mean per unit is not really a good one to use. The variation is just too big. And when you actually, when you do the sample size, you get a monstrous sample size if you do this. So mean per unit is not usually this one. Ratio estimation is appropriate when the errors are likely to be in proportion to the say related items. In other words, large items will have larger errors than smaller items, which is probably the way most things go. I mean, if usually if you have an account for $60, it's not going to be misstated by $4,000. Yeah, you got to account for $60, maybe misstated by $5 or something. So usually the smaller number items are usually misstated by smaller amounts. You get to a larger account, you get an account that's 480,000. If it's off by 4,000, that's probably not that unusual, right? So in other words, there's a relationship between the dollar amount, dollar value of an item, and the error. Large ones, large errors, small ones, small errors. And that's, I think, the way most things work. Ratio estimation is probably the one that's, I think, theoretically the best if you're unsure of what to use, because it seems to make the most sense. As far as, unless there's something unusual in the sample. Difference estimation is sort of the opposite of this. Errors are likely to be the same for all items in the sample. So the errors are likely to be the same for all. So, a misstatement, I think I used an example of a handling charge. Maybe the handling charge is $10. And sometimes the salespeople remember to put it in, sometimes they don't. So so this handling charge is $10. So salespeople forget to put that in. It's supposed to go in for all of them, but they forget to put it in, whatever reason. Just made it up. But if so if it's a $500 order, they'll forget the handling charge. If it's a $50,000 order, they'll forget the $10 handling charge. So if it's off, it's likely it's off by the same amount regardless of size. That's when you use difference estimation. And again, it's almost a challenge to come up with scenarios where that would happen, routinely. But it could happen. I mean, I'm not saying it won't, but the idea is that the misstatements it's likely that they're exactly the same size or pretty close to the same size for regardless of what the size of the item of the sample is, whether that's $10 or $10,000. So difference estimation is, again, it's only for those things that are likely to be off by the same amount. And like I say, my guess is that most accounts are going to fall into this one. This is, probably what you're going to use. This is what I used a lot when I did internal auditing, but same idea. This is the only one I used. Just because it was the most appropriate one, because I was dealing with accounts that were all over the place usually. I was an auditor for US Steel and Navistar, which US Steel makes steel. You guys probably picked up on that already. But the Navistar builds trucks and stuff like that. So, you know, we'd always have audits and that the pricing of trucks can be all over the place. You have trucks for 30,000, you have trucks for 300,000, you know. So ratio estimation was always kind of the one that we always just used, just because we never really had any reason to use these other ones. And it makes most sense, you know. Small items, small errors, big items, big errors. Question on that? And you know, the actual collecting of the data is exactly the same for, you know, when you collect the data, this is, you know, you collecting the data is exactly the same no matter which method you use. It's just a matter of how do you take that thing you collected and project it over the entire population. Any question on that? Okay, any other questions on it? And again, yeah, just do 3 and 4. They're somewhat similar to, you know, what we just, you know, what we did for the other ones. Any questions on either of those 2 problems? Would you like to do one together? We want to do number 3? Just give me the silent treatment.
I had a question on 3E.
Okay.
Okay, so for the projected misstatement,
Mhm.
I got negative 60,000, which I just put as 60,000. However, when you do the projected value, do you do the 60,000 plus the 700,000, or do you do negative 60,000 plus
Negative,
700,000?
good question. Negative 60,000 because the audit amount is less than. Yeah, so this is what divided by 30, right? Something like that. Yeah. And this one was 33. Yeah, so what we're saying is that, look, this book value, this is actually overstated. Oops. Right? You know, if they're saying, you know, if we say that the audit value is 30 and they're saying it's 33, this is overstated. So you're going to reduce that. So 700 will be negative. Just like you said, negative 60,000, you're going to subtract it.
Okay, thank you.
You're welcome. Any other questions?
On the same question, the D, so if, let's see. So the ratio estimation, the projected misstatement, the C, the project, so that one, is it going to be positive or is going to be negative? Are you going to subtract, or it's just for the last one that it becomes negative?
Well, the last one you have to do more calculating with, because this one, it'll actually give you a projected value. And this was a little bit more.
Okay.
Yeah, but we'll do it. So this would be, so it was 33. Oh, yeah. I'm sorry, it's 30. 30 divided by
33.
Times the book value. So 100,000. Yeah, so this one's going to naturally come out to be less. You know, it's going to be it's overstated. So What's my calculator? Okay, so. So you came into what, 6?
Yes. 636.
364.
Yeah, 364.
Okay, so this will be the projected value.
Yeah.
And the total book value is what, 700,000?
Yes, 700,000.
So that'll be a mistake of,
It's actually 636 comma, not a period. Sorry.
oh, yeah. Oh, you're right. Okay, so yeah, so it's good. So this would be a misstatement of
63, 636.
the 63, 636, you said?
Yeah.
Yeah, and this will be an, yeah,
Okay. Okay, so the only kind of change will be on the E where like you'd have to subtract instead of adding when it's overstated.
correct.
Right. Okay.
Yeah, for these ones, you know what the projected value is going to be, and
Yeah.
if the projected value is lower, it's overstated. If it's higher,
Okay.
yeah, I understand.
Okay.
Professor, like as far as I understand, the projected misstatement should always be positive. How can we write like it? It's a difference. So how can we write the difference as a negative figure? So it should so like in the answer section, we should always write it as a positive number. Like in E, we should write it as 60,000, not
Yeah.
a negative 60,000, because it's asking about the difference.
Quite honestly, I don't. If you put the misstatement as a negative, that's fine. I don't mind. This is negative. You know, as long as you mark it as overstated or understated, that's fine.
Okay.
You know, and anyone looking at it would know. You know, basically what you're saying that it's off by. So. Yeah, that's fine. Yeah, so if you put this as a negative, you know, the statement is as long as you put it, what do I do here? Yeah, it is overstated. That's fine.
Okay.
Questions? So audit average, then mean per unit is audit average is what, 30? Times the items in the population is 20,000. So this one says, okay, 600,000. So this would be equal to projected value. And this statement would be Minus the book value. Oops. $1,000.
So is it minus or just?
You can put that as minus. That's fine. No problem.
Oh, okay.
Yeah, and this would be an overstatement that they're saying it's. They're saying it's worth 700,000. We're saying no, it's overstated. It's only worth 600,000. So, and if you put this up here as a negative, that's fine. You're gonna put this. You put this up here as a as a negative. Now, you're saying it's been stated by 100,000, so that their book value of 700,000 is too much. Question on that? Yeah, we'll do the last one just for fun. I should probably keep it the same way I did it up here. I just can't remember half the time how I did it before. Okay.
Professor, can you come back to question 4C?
4C? I didn't do 4C. You have a question on 4C? On this one?
Oh, okay. So just now you did, which one was that? It was 3.
I was gonna do.
Oh, okay. You were doing. Oh, you were doing C of question 3rd. I thought it's question 4th.
No, yeah, I was just I was just gonna start doing this one. This one is the 30 minus the 33. Times 20,000. All right, so every item was stated by $3 times 20,000. So the misstatement would be 60,000. So for this one, the misstatement would be a $60,000. This is number 3. Overstatement. And so the projected value would be 100,000 minus the overstatement. And this is kind of a weird one in that you get the projected misstatement first, and then figure out the projected value. So you're gonna say, okay, all these are misstated. They're all overstated by $3. You get 20,000 of them. The total thing is overstated by 60,000. So we have to subtract that out to get the projected value. And again, this one is, you know, is generally used for those things that are most likely misstated by the same amount. That's usually what's the most useful at. Question on that? Okay, so from that, you guys can probably do number 4, or it's very similar to this one. And if you're unsure of something, you know, you can go ahead and email me, or you know, if you send it in and say, you know, can you look at this or whatever. Unless you do something completely silly, you know, you're gonna get the points anyways. So don't be you know, so afraid that when you turn it in, if it's not 100% perfect, you say it's overstated as understated, something like that, I'm not going to take off points for that. But you know, try to do it correctly, obviously, and then when you get to the exam, you really want to do it correctly. But you know, don't worry too much about this one. But you know, do your best with it. Don't leave it blank. If you leave it blank, I'm not going to give you any points for it. But yeah, so see if you can work out number 4. And again, if you have any questions on it, you can go ahead and email me. Any other questions specifically on this? All right. Well, give number 4 the old college try, similar to the other ones. This video will be posted hopefully by midnight. So if you need to go back to it, you can. If you wanted to just take a screenshot right now, that would be, you can actually see kind of what the, at least for number 3, and how we did it. Okay. Well, again, it's due Friday. If you have any questions on it, feel free to contact me. If not, I will say adios. I'll see you guys in a week. The only thing well, actually, I'll do it right now. I'm going to add in the Accounting 433, Chapter 1 and 2 handout. And we'll make that due in a week from today on Friday. 100 points. Submission details. Oh, another thing too, though, as you go through these submissions, notice that they're unlimited attempts. So if you did something, if you do it wrong and you realize it later, you can resubmit it. So.
Which one is this? Is it the old one?
Yeah, this is the classical sampling one. Yeah, some people have already turned it in. So if you already turned it in, I wouldn't worry about it. But if you haven't turned it in, I'm sure you do. And then accounting 1 and 2 handout was the one we just finished up today. The last couple pages on.
Are we supposed to turn that one in when?
It's actually due. I should put it down as due a week from. I usually go to Friday and then a week from Friday. Just give people time to. And by the way, even if it goes past that time, you can still turn it in. But at that point in time, I'm going to put it into your grade. So your grade to date is going to show that in there. Point being, if you don't turn it in by that date, there'll be 0 in there. Your grade will not look very good until you do turn it in. But you can still turn it in. Don't think that just because there's a 0 in for your grade, that's it. You can still turn it in, and I'll change the grade, but until you do turn it in, I won't have anything to grade. So, yeah. So just even if you miss the turn-in date, still turn it in because you still get full credit for it. It just won't be in your grade to date until you do turn it in.
Okay, so I'm kind of confused with this one. Which assignment is that one? This one, the 1 and 2 handout.
Yeah. Yeah, there's one. Yeah, just turn in what you got with the stuff that we wrote out. Some of the stuff. Don't worry about it if you don't have it highlighted exactly like I do.
Oh, okay.
Yeah, but some of the stuff that we wrote in here.
Oh, okay, got it.
So, again, and if I didn't write anything in on it, I didn't put anything in here. Don't worry about it. Just turn in whatever you got.
Okay.
Yeah. Some of the other handouts I have will have more, actual stuff, not kind of definition-y stuff, but actual work. So. Yeah, and if you want to look ahead, you can see. I sent out the chapter 10, 11 handout. You can kind of see what we're going to do next. So. Okay. All right. Well, I will see you guys in a week. And again, if you have any questions on any of this stuff, let me know. Happy to answer. Okay. All right. Have a good night.
Okay,
Good
bye.
night, Professor.